Well, good morning, everyone, and thank you for joining us on October 1st. Our WebEx is live trading using Netto Numbers and emotional algorithms. And today we have the pleasure of welcoming Netto and Denise Shull. They will be at the helm for the next hour and a half in a live trading session. And you guys are more than welcome to ask any questions on your WebEx. In the lower right-hand corner, you'll see a Q&A section. Also, at the end of this presentation, we will post John and Denise's emails if you want to directly send them any questions. The next area we need to quickly cover is just our risk disclosure here. I'm not going to read the entire risk disclosure. Most of us on this call have seen this at one point or another in our career. If you haven't, please hit the print screen button on your keyboard if you want to capture a copy, or certainly send us an email. We'll send you the risk disclosure. A little bit about Denise and John. Denise is the president of the Rethink Group, and she has been on many TV shows, and her book is Market Mind Games, a radical psychology of investing, trading, and risk. And then John is president of Protean Trader, and he has a book coming next year. It's The Global Macro Edge, Maximizing Return per Unit of Risk. John has also appeared on many TV programs and radio shows. And without further ado, I'm going to go ahead and turn this over to Denise, and then John's going to come in, and over the next hour and a half, we will watch John's trading, and then I will periodically come in with any questions that you might have for John or Denise this morning. Thank you. Denise, go ahead.
Thank you. Hi, everyone. So let's just jump right in. It's not really well known because I guess the research is relatively recent, but in essentially the past 5 to 10 years, there have been two kinds of studies done on what is it that makes a great trader. And both types of studies have really ended up at the same place. One type is neuroscience, where you're looking at traders or even non-traders watching price action and being able to predict where the price is going to go. And obviously some people are better at that than others. The other type of research that's been done are interview studies with, well, it's actually closer to 200 successful portfolio managers, traders. And those interview studies, then you analyze that what's been happening is that the text has been analyzed for what they are really saying about what makes them do well, and that's been correlated actually with their compensation. So you could say within an interview study that these people with higher compensation are talking about these kinds of thinking styles and these kinds of analyses that they do. And what's been found through the interview studies and through the brain research is essentially the same thing, that there are two thinking styles that are related to emotions, but not in the way you normally think of emotions in trading, meaning take it out. It's more about including it. The sixth sense, John Netto's emotional algorithm, the self-knowledge to know whether you're feeling an intuitive, unconscious pattern recognition feeling, or whether you're feeling an impulsive feeling that is driving you to do something that's not really reading the market and reading other people. So, in broad strokes, these are called market intuition and risk differentiation. Market intuition is really about reading what's going on in the market, and it's a result in the brain of the same areas in the brain that work with empathy or what's called mentalizing. And, you know, some of you may have noticed there's a television show that's been on out there for years called The Mentalist. What's he doing? He's really reading what's going on amongst other people. This has been shown literally in brain studies where the blood flows when people are correctly predicting price action. That's the parts of the brain that are associated with reading other people. So in practicality, it's thinking about who is or will be on the other side of the trade, what's the crowd feeling, who will be on the other side of your potential exit. Now, I buy it here. Why is someone else going to pay more for it 5 minutes, 5 days, 5 weeks, 5 years from now? That kind of thinking has been identified in both brain studies and in interview studies as key to essentially being a better trader. On the flip side of the coin, on the risk side, essentially self-knowledge, a specialized form of emotional knowledge or emotional intelligence, knowing where you are in a fear to confidence spectrum, knowing what kind of feeling is an intuitive feeling and what's an impulsive feeling. Impulsive feelings have more energy. These two ways of thinking about the market have been identified essentially at this point over and over and over as the key thinking styles of exceptionally talented trading. John Netto has them, uses them, and will try to identify them today as he does it in real time. I wanted to give everyone sort of a level set of what we're looking for. So, to underscore this idea, a relatively, I think, surprising to the world of trading result of what's called a meta-analysis. And a meta-analysis is when you study, when you correlate, or when you put together all of the results of multiple studies. So a meta-analysis was done on all of these different brain studies that have been done on risk perception. And what they essentially found at the end of the day was the very first thing your brain does when it sees a probability distribution is turn it into an emotional meaning. I'm going to say that again. The very first thing that happens in your brain that you're probably not conscious of at all when you look at a probability distribution is your brain turns it into what does it mean emotionally. So a normal distribution, a normal bell curve, gives you a sense of feeling of confidence. A skewed distribution gives you a sense of anxiety. And so they came, this was done actually out of Stanford, and the name of their theory about it is anticipatory affect, meaning you see the probability distribution, you expect to feel a certain way. So why is this so important? Your expectation of how you are going to feel that you very well may not be conscious of because it's happening inside your brain and you've all been taught to ignore that feeling, right, is coloring the rest of your analysis. So I tell you this to underscore how important it is to actually start to think of emotions and feelings as data in your trading, because you won't be able to make a decision. By the way, this is also a neuroscientific fact. There has never been a decision made without an emotion. So just stop saying take the emotion out of it. You don't need to act on the emotion, but the brain uses what you experience as emotion as data. And you are best off to start to know what that data is, because then that gives you a choice. Which data is telling me that I'm recognizing what other people are feeling and what other people are likely to be doing, and which data is compelling me to do something because I had a bad morning or I'm tired and I feel like I should take these trades, but that feeling is really about something else not related to that probability distribution or your reaction to your pure market data. So with that basic opening, I'm going to give you a handful of resources that you can check out later. Obviously, my book, Market Mind Games. We have a whole series of self-study for developing these two thinking styles, and we've just released a talent assessment tool for hiring that tests exactly for the ability to read other people in markets and the specialized form of emotion knowledge. So with that as a backdrop, I'd like to turn it over to John, and then as he's trading, we'll try to identify both these thinking styles and then levels of detail in terms of fear and confidence and other things that might be going on either also for other traders that maybe John isn't quite experiencing or quite demonstrating. So I appreciate the opportunity and think this will be a great event. I'm glad you're all here.
Thank you, Denise. Thank you, CQG. This is something that this is probably the highlight of my year, giving me a chance to come and to trade and to share with everyone out there the benefits that I receive from collaborating with an amazing team. I Okay, there we go. First of all, you know, when I started off in this business 15 years ago, I come from a Marine Corps background, and I wanted to take that marksmanship philosophy, the philosophy of a sniper, in terms of to find that one precise trade, to have that discipline and to pull the trigger. And that is the core, that's the framework, that's the basis from which I operate and from which I trade the markets. It's that patience, it's that discipline. But and that came from a highly technical approach. And that worked, and that helped me develop the aspects of risk management, the aspects of those trading instincts that Denise just spent the last few minutes talking about and going into. What was always lacking, or what was something that I needed to develop further to really get to the next level as a trader and see my P&L from both a nominal and risk-adjusted basis get to the next level, was to understand the macro narrative behind what the trade was, and to be flexible and fluid, understand which events could potentially impact the market in what ways. And so that fluidity, that flexibility is why I embrace the term protean. Okay, Proteus is an ancient Greek god, son of Poseidon. He could take on many shapes and forms, and so you see that term used nowadays. In essence, he's a protean actor, a protean composer, or a protean chef. And that same philosophy, given the way these markets are, given the adaptability required, is the basis for forming the proteantrader.com. Like I had alluded to earlier, when I talk about a protean strategy, I would describe what I do as being a high-velocity macro trader. So I take these, or I look, working with my team, take these macro narratives on top of technical dynamics. So I come in every day, look at where the market's situated, understand how it's trading, and then understand where, or from any perspective, there's a macro narrative involved in that. So I'm looking at key technical levels like Fibonacci, economic data that comes out, what the sentiment is, how is the market positioned. I spent a lot of time in the last 4 or 5 years really developing a sense of how certain events would impact things, and then overlaying technicals on top of that has really helped give me the ability to maximize return punitive risk. And then other exogenous factors as well, one-off events, catalyst events, you know, wars, weather events, things like that, earthquakes, fires, floods, et cetera, et cetera. And again, there's what I found from going back in the last 15 years, and this is something that Jason Roney, from Bluegrass Capital Management, I regard him as my trading mentor, taught me, is that you can take a mediocre system, but if you put a macro narrative on top of that, that mediocre system becomes much more effective. In other words, if you can understand, like this morning there was, you know, we just got a big uptick in the Treasury market, both U.S. and German Treasury market. Well, as I'll talk about in a little bit here with the Site Beyond Site newsletter from Rearview Macro, there is a macro narrative out there that is in play of deflation. And so if you take that macro narrative in play of deflation, and maybe you don't like to be a trend follower, but you like to buy pullbacks. So right now, my short-term technicals are bullish on fixed income. So take that macro narrative of deflation dynamic, and it gives you that bit of confidence where maybe a trend following system might be only produced marginally. Now we have something to validate that, and we can move forward. I also look at spreads in the market, whether it be natural exchange traded spreads or the synthetic spread, something like gold priced in euros, or what the spread is between the S&P 500 and the Dow Jones Euro Stock if I was to try and trade those in a relative value strategy, and then long and short gamma. So, how is the market positioned from an open interest standpoint? What's the optionality of this trade? Things like that. And so those are all factors in the protean style. You can see there's a lot of things that go into that, but there's a message and there's a real qualitative aspect or a real interpretive or intuitive aspect on top of a very well-defined trading framework. The four biggest things that I use for my trading success as a CQG integrated client, and so it's no coincidence that this is, it's a time for another webinar. For me, I have a team around me, and the first thing I read every morning is the Site Beyond Site newsletter from Rearview Macro. I would encourage everyone to go there and sign up for it. There's a free 2-week with no credit card, but I'll give you a little bit of example of how I would read that and come into the day. But in essence, Neil Azouz, who writes this, speaks at length with a number of institutions. He also puts out a portfolio. So it's very valuable for me as a short-term macro trader to get a sense of what the macro narrative is, and to have an ability to filter, track, and prioritize what those themes are, and when I can, put those themes into play, go from there. Trade the News, it's an audio blog again, trying to use the resource of technology. They do a big deal, and then TweetDeck, because depending on what the theme is, I want to track the tweets in the market and understand, okay, this tweet is big, and I have a few guys that I follow to see, okay, like a news announcement's about to come out, like we have ISM coming out at 10 a.m. Eastern time. I'll put, ISM in my TweetDeck and see who's cycling through that as a result. Specifically with the Side Beyond Site newsletter, let me go to, there's 5 components or 4 components to it that I find particularly valuable, and if you're going to have a newsletter or you're looking to help outsource where you get your macro edge from, these are the 3 or 4 things that I think are very, very important. The first thing is, and I'll go ahead and go to share my desktop now, my desktop. Boom, boom, okay, boom. Okay, so the first thing to me, because everything I do is assess the market on a risk-adjusted basis, when I come in, and whether it's with the Netto Number Dashboard or it's Neil's RiskAdjusted Monitor has a more expansive universe than mine in terms of the products he covers. So the first thing I want to look at is, all right, from a cross-asset basis, which risk-adjusted return monitor, or which risk-adjusted asset performed the best and worst overnight, and what does that tell me about the macro narrative? This is something that Jason Roney impressed upon me greatly in terms of understanding where potential money flows are at, and this is something that Neil is very, very acutely aware of and talks about and leads with every morning. So we see dollar, Korean won perform the best on a risk-adjusted basis, and by risk-adjusted basis, just conceptually, it means how has that market performed relative to its own relative performance. And so that's different than just which markets perform the best on a nominal basis versus which has performed the best on a risk-adjusted basis. That risk-adjusted basis really conveys a different macro narrative about where money flow is going and how you should be positioned and what potential blind spots exist. Overnight, the worst market is platinum. So, okay, so let's just think about the macro narrative for a second. Dollar Korean won is the best. Platinum is the worst overall, all right? We know the treasuries are rallying. We understand that both in the U.S. and abroad, we're seeing in terms of risk, platinum being the worst now. There's some other indexes out there, whether they be Europe. You look at Ford's price action yesterday, that are indicative that play into this theme that deflation is the theme we're seeing in the markets today or in the last couple of days. And you have to ask yourself, all right, this is the process I'm going to use to put together how people are positioned, and is this deflation story something that's priced in the market? Is it only partially priced in the market? And effectively go from that. So that's, we look at fixed income. German worst overnight were the German bobbles. Best was the Korean on 10-year. Again, so we saw dollar Korean won doing well. We're seeing Korean 10-years poor overnight. Australian equities doing well, and we see WTI crude doing well overnight. Now, this is where a little bit of context comes into play. That from an overnight basis, all right, so we see crude doing well overnight. That's not necessarily a deflationary sign, because when you think about inflation kicking up again, that's a place it should go. But let's take a context of like, all right, how is crude done overnight versus how is crude done on a 3 or 4 day basis? So this is a good primer to give you a place to go, but then you need to contextualize, all right, what's the next message going on here? Then Neil goes into his overnight deal. I put a link up on there so that everyone can go ahead and download that. Amia, can you let everyone know how to download this, or go to the link to download this newsletter so they can at least follow along and go back and reference some of this stuff later? Amia or Doug? Yeah. Okay.
John, we'll work on that.
Yeah. Okay, cool, awesome. So they're going to upload a link here, and worst case scenario, I'll send out this newsletter afterwards. And so here's the overnight narrative. Neil goes into that, talks about, Euro, Swiss, and mapping key currency level near the 120 level. Talks overnight about what's happening with China being closed down, the dollar Korean won. So he provides some context and an overnight summary to what that risk-adjusted dashboard entails. So all right, fair enough. To me, platinum, inflation, at least the way I'm interpreting this, or deflation are the factors to keep in mind. The next thing that at least, so then the U.S. growth narrative, we're coming on to the beginning of the quarter here, and looking overall at the driver. Clearly, as most of us know, we have the ECB meeting tomorrow. Neil goes into this talking about Mario Draghi and certain aspects and certain risk dynamics that are at play right now. Clearly, at least the way the market's position, as Neil's articulated here and as I feel as well,
the market is expecting the ECB to lay out some guidance and is positioned accordingly. So if, for whatever reason, the ECB comes out tomorrow and is a little more hawkish than most of us are anticipating, this is something that could definitely rock the boat, which is why, given the ECB meeting tomorrow, given the non-farm payroll number on Friday, we can look at implied vols now on both the weekly TYA options and overseas as being particularly high, given where it's priced in the previous weeks, and given the event risk and headline risk after, that makes a lot of sense. That's pretty intuitive. He also makes a note in here that the difference in the 10 and 30 year fell to 69 basis points, so meaning we have a flattening yield curve dynamic right now. The last time that it was at this spot was March 6, 2009. So, that's the last time, and that was a real deflation environment, the end of 2008, first quarter 2009. So it's just a good context. I would not have, had that historical perspective. Also, again, another point that corroborates this, at least in terms of assessing how other market players are thinking, which is going to go into my emotional algorithm, if you will, is, the performance of the dollar index. The dollar index had its biggest quarterly performance. Obviously, this is day one of Q4 since 2008 or 2009. It was 5 or 6 years. So there's some real aspects to how the market is positioned that we want to pay attention to. Most of them are along the deflationary front. Most of them are involved around being long, U.S. fixed income and European fixed income, and being very tactical with how you trade equities, because of a deflationary environment is not good for too much. It's good for the dollar. It's good for AAA fixed income, and it's potentially good for being long dividend paying stocks versus emerging market stocks from a spread basis. But gold gets whacked, commodities get absolutely annihilated, commodity currencies get crushed. So these are things that you want to keep in mind. And now that we have that backdrop, we can look for technical points to provide liquidity and fade this move. And then the last thing that Neil does, which I like a lot, is he provides a model portfolio. So he's given a model portfolio, overnight observations. I don't have time to run through all of this, but then at the bottom here, there's a portfolio, so I can get a sense of, all right, how is this hypothetical $100 million portfolio positioned? And again, I can understand the mindset behind this, and I can understand action. I'm a guy with my research, Jason Roney's this way. I know that, Bill Glenn, who also wrote the book, we all want clear, crisp trading ideas to work off a portfolio when I look to go do third-party research or when I'm looking to outsource trading ideas. This website does that excellently, superbly. Wow, I just said that word. Okay, I'm still tired, everyone. Fair disclosure, I'm a diehard A's fan. I'm born and raised in the Bay Area, and that was, for those of you that watched the Royals A's game last night, for me that was just, you might as well just rip out my kidneys and just friggin' stomp on them, okay? Because that was just brutal watching them blow two saves last night. So I'm a little winded here, but ready to go and fired up nonetheless. So at any rate, that's the deal with that newsletter. We have 7 minutes to the open. This is, in terms of those things I just talked about, one of the least edge days I've seen in a long time in terms of how you want to get too crazy. I think the way that I'm going to play this next 65 minutes, well, the way I'm going to play this next 48 hours, and then you'll get a glimpse of that for 65 minutes, is begin to position myself to where I'm buying pullbacks in fixed income. And one thing that's been noted out there is that you have the disparity between German fixed income and U.S. fixed income as the interest rate differential out there between, or at least the economic prospects between what the U.S. is going to do and then what the central banks of the ECB, the SNB, the Central Bank of Australia, just basically everyone but the U.S. Showing how they, how they're targeting interest to the downside. So to me, what dynamic this creates, and this is a little bit counterintuitive, but it's something that it's something that I like to play off of, is I'm gonna go ahead and buy some fixed income here on this pullback. This 103 plus is a good place to get a little bit long. Yeah, let's get some 125.03 plus out. What was I saying? Oh, is this disparity. So there's a perception that, U.S. economic growth is strong, as obviously we saw in the last quarter, versus European growth. There's deflation, or at least disinflationary forces everywhere. So what happens now if U.S. economic data doesn't keep up? And so it's a bit counterintuitive, but to me we have the ISM come in here in 33 minutes, and, you know, we saw the German CPI data earlier in the week. Well, to me, if this ISM disappoints, okay, there's an opportunity for fixed income to rally, and even rally relative to German fixed income. So to me right now, we have the bid and the Bund, which is and the bid in U.S. fixed income, which is holding things up. So I'm stepping in here, and I'm going to begin buying. Let me change to a different share. Okay, share. My desktop. And I'm firing a lot at you guys. That's my style. Okay. So let me see here. Whoops, that's not what I wanted. Share. Okay, 7. All right, cool. All right, so here's where day sits right now. I'm down 2,600 early. I was long some fixed income. I was long actually treasuries, both 5s and 10s before the ADP. Again, playing for a move, but I thought that if the ADP came out weak, we'd get a big rally up. Well, actually, the ADP came a little bit hot. So that concept for me was diminished because I talked about how I play market positioning. And so it ended up, of course, that, you know, 5 minutes after the ADP was released, we get a big impulse higher, but it was not necessarily from a weaker ADP number. So we have a trend in place. So it's worth providing some liquidity on a pullback here, 125.03 plus. There's one of Bill Glenn's balance points. I rely on him pretty strong as my technical. So you continue working, just a little bit of position here. And I'll step in front again because of, again, how I see this market set up, probably around 945, 950. Because, again, I think that in a perfect coin toss situation, if the survey on ISM is at 58.5, and the survey comes in at 57 versus 59.5, 57 would really begin to question some people's perception about what the perceived interest rate differential will be between the U.S. fixed income market and the European fixed income market. And I think that gives a great shot for U.S. Treasuries to rally and create a little bit of a short squeeze. So that's my mindset right now of what is conventional wisdom, i.e. deflationary forces, more in Europe than in the U.S. But if we get some weaker U.S. data than people expect, there's an asymmetry existing there where I can be long U.S. Treasuries, and that's my mindset right now. It didn't work earlier. That's what I love about the live trading. We don't know what's going to work. We don't know how it's going to play out, but it's something that I'm positioning for and working some areas. I'm also working. You can see some boom down here as well. These are all my orders. So I'm long 10 TY right now, and I will keep that as just something to sort of have a foothold in that market. We routed at 125.07, pull back 125.03. I'll probably get long at 125 plus 125.01 and take it from there. But in terms of getting too exposed, it's the first day of the quarter. Right now, U.S. equity market is opened, and we'll go from there. Denise, go ahead and fire away. I'm sure you have some questions for me and stuff like that.
Do I have the
Yeah, you're on. Yeah, you're on.
So, for a lot of people, John, what you just went through might be a little much. I saw someone type in that they were having trouble keeping up with it. But if you take a step back, John's taking all of these different sources of data and information and analysis to do one thing: predict how other people are going to react to essentially the latest news. So he's got his complete backdrop, and then he's got today's ISM number. And, right now, the comparison between U.S. Treasuries and German fixed income. So it sounds maybe potentially overwhelming if you're not working at John's level of data analysis. But if you understand it through the view of how do I take the data I work with and spin it to understand who else is trading in which direction for what reason, which is, certainly a level beyond what's on the chart. Now, that is the beauty of technical analysis. People don't realize it because they take it too literally, but if you don't take any technical analysis indicator so literally and you understand it through the view of how do I predict other market participants, Your brain, the human brain, is naturally inclined to think like that. We all use predicting other people to navigate through our entire day. Certainly to navigate transportation is the easiest one to understand. Whether you're driving down the highway or walking down Lexington Avenue in New York, you have to predict what other people are going to do, and you're doing it all the time. So the trick to move your thinking style of market intuition is to do it consciously. Now, if you really deconstruct what John says, what he's just said in the past 20 minutes, he's not specifically saying what are they doing, but as he's putting together his economic, his sentiment, his technicals, he's actually looking for the answer, like how are other people perceiving this assembly of information? So you can move along the scale of what John's doing by simply putting everything in the context of how do I understand all of the different market players. Now, if that seems difficult, think of most of the market players like yourself. And I realize people will go, well, that doesn't really work because there are all these different kinds of market players who may be more sophisticated or less sophisticated. But it's the process of your brain thinking about the other people, and the easiest way to do that is to project yourself. It also, that trick of projecting yourself into what the price is, keeps you out of bad trades. It helps you realize sooner that, hey, wait a minute, you know, if everyone's thinking this, then it's probably not going to happen, or everyone's already in the trade. So I wanted to put John's voluminous data and intellect and experience into the context of what he's really doing from a brain point of view and how it connects to the market. I don't know if we've got any questions yet specifically related to that, but that might be helpful if we do.
Yeah, that let me get this out of the way here. Do that. Doug, are we, as the moderator, are there some questions in there right now? I definitely have a lot more to get into. How do I get sharing to the, how do I resume the presentation? Because I have some more slides to hit on. As we're seeing a little bit of an uptick, looking at institutional retailer, just, okay, from Joseph to all panelists. I'm looking at all factors, not just institutions, not just retail, but actually everyone. And that's one thing that when you look at the Rareview Macro newsletter, Neil has access to a number of family office institution types. And so, you know, I want to know what their thinking is. I talk to a lot of guys, and just the mindset of, there's some good books out there, which if you're not, you know, to understand the sort of typical macro mindset, I would say like Inside the House of Money, or More Money Than, Inside the House of Money by Stephen Drobny, More Money Than God by Sebastian Mallaby. Track.com is a website I go to that puts together idea dinners. But I'm basically, well, like Denise said, I'm always trying to handicap how or what people are thinking about where the market can go. And so for me, frankly, there's not always a lot of difference between what the retail guys are doing and what the institutional guys are doing. I remember when I first got into this business, like, oh, the people with all the money are so much smarter than me. They're so much more on top of where things are going. It's like, actually, the emotionality and the animal spirits that come about from the markets are surprisingly similar in someone that's been doing this for 30 years and someone who's been only doing this for maybe 30 days. And I think an acknowledgement of those animal spirits can really help a trader go a long way. Denise, do you have some comments about that?
Well, I just typed them into the chat, actually. That's so true. I can tell you from having coached, you know, every kind of trader there is, from retail to, you know, someone managing $1 billion of their, you know, within a multi-billion-dollar hedge fund. There's just not that much difference. At the end of the day, the difference is the guy managing the $1 billion makes fewer mistakes, but they make the same kind of mistakes for the same reasons as the retail guy, really. They might have more sophisticated data and a better understanding of what's going on, but their tendency to be tired and take a bunch of impulse trades is basically the same. Their tendency to, you know, stand back from the market and then get frustrated that they've missed a move and jump in is the same. Their tendency to work out whether they're trying to prove they're smart is the same. It's just, there's not that much difference, really, in the psychological and therefore the behavioral and therefore the aggregate of how people react to price moves.
I'm offering out that 10 lot here. I think technically I can see this market pulling a short-term little respite here. That was a nice something. We'll see if it comes back to me. I'll probably bid into it again. We're 22 minutes away from that ISM right now. That 06 half hold is a pretty big spot from a market profile perspective. 06, 06 half, 07. If they're with me there, I'll give them some liquidity and take out and look to re-enter on a little bit of a consolidation. Again, first, we're talking the first nine minutes of the quarter. S&Ps are making new lows right now as we go into that. From a risk-adjusted, let me go ahead and bring in this spreadsheet when we talk about Netto numbers. A little bit of background on Netto numbers. We now have the, let me go ahead and slide this across here. Whoops. Actually, I'll just go to share a different monitor. Boom, boom, boom. Here we go. Okay, two. All right. Again, I talked about Jason running Bluegrass Capital Management, and the P&L that I've had over the last few years is truly a byproduct of the team that I work with and who I'm able to collaborate with. And one of the things, and I would say that the biggest virtue that I've received from Jason and his team is the creation of Netto Numbers. Jason Bluegrass has a number of robust risk management metrics to assess the market from a risk-adjusted basis. That was a big flush in the S&P there from a risk-adjusted basis. And so that ability to do that, I wanted to come up with something. I asked him, I said, let's make something that's much less complex, okay, to where everyone can apply it and begin to look at the market through the framework of a risk-adjusted basis. So that's where the Netto number came from, was from Jason and his team, so that I could begin to teach people how to look at the markets in the space. And so this is a CQG Netto number risk-adjusted dashboard, okay? And I'm obviously very thankful for Jason for agreeing with me on sharing this with the public. And you can look at here in terms of like, all right, so from the Netto, which markets from a Netto number base performing the best and worst? And so the top 5 right now from a risk-adjusted basis in real time using the CQG dashboard, all fixed income, okay? We're talking European gilts, 2s, 5s, and 10s, and 30s. And then on the worst adjusted basis, Honeywell, Honeywell, GE, and then Cocoa. So you have a commodity in there, and then looking at, from a 5-day or longer-term basis, the USD Hong Kong dollar, we can negate that. Coffee, surprisingly, is not doing too bad. Nat gas spread, dollar Korean won, which you mentioned earlier, from a longer-term Netto number basis, and going from there. So that's a little bit of the rub. S&P making new lows right now. We grabbed a little bit of that TY, but we're going to be back fully long again before 7 o'clock here. Technically, that spot appeared to be where they can maybe pull back a little bit, and I think that's still possible. But we'll start to work that. I will have a little bit of a bigger position out there before them, because if we do get a miss, I do think there's an asymmetry to play the ISM and to play treasuries to the upside on that miss. So we'll keep that going. But back to this Netto number dashboard here. So obviously grouping the cash forex, IM currency. So New Zealand dollar up. On the week, the New Zealand dollar is actually down 1.2 risk multiple. So that's something to keep in mind, that disparity. So you want to look at the short-term risk-adjusted performance and then the long-term risk-adjusted performance, and go from there.
Hey, John.
Yeah.
What if I wanted you to take the red off your screen?
I've done that in a lot of cases. I actually have, like, because of the webinar you gave with CQG earlier in terms of it stimulating some things. But I'd have to ask Tom Harville to do that. And Tom's a great guy and all, but he's done a lot of work already for this. So I'll see if Tom can make that happen.
Yeah, the reason why, gang, is the research shows that we react to red unconsciously most quickly. So it doesn't matter so much on the Netto Numbers dashboard. But I just wanted to bring up the point because I noticed it also on the screen I noticed it. Over the years, as I've shared this research, on Twitter and in other webinars, I can't literally tell you how many people have said, I didn't want to do it, I didn't want to do it, I didn't want to do it. I finally decided to try it out of, whatever, I might as well try. What would it hurt? And I feel so much better. I'm so much less stressed. I have so much more energy in the afternoon. And it's because you're not actually tweaking your brain quite as fast with quite as much intensity. It plays into something called decision fatigue, and that is we do get tired making decisions, and there is only sort of so much willpower that we have, so to speak, and those things play into people making money in the morning and losing money in the afternoon, literal physical energy. So things that you can do to increase your physical energy and therefore make it easier to stay in the thinking styles that will help you put down a greater P&L, change that red to purple or something. I've had people do, blue and yellow, brown and green. I know it's hard to find other colors besides red and green. I know it is, but I just wanted to point out to everyone that the research does say that, and everyone who's reported to me over the years that they've taken red off says that they have more energy at the end of the day.
And to be fair, like when Denise said, this is my main global macro dashboard in terms of that I have links to the charts. And you can see this used to be green and red. There's still some red with the actual writing, but this used to be all green and red here, Denise. So I have made changes based on the webinar you gave CPG 2 years ago. The issue with the Excel spreadsheet, and this is fine, is that obviously the way it's programmed in Excel. But I'll go back and make that adjustment as well. But my charts, most of my charts have either they're in black and white or they're built around. We're also making new lows right now. And you can see here just initially, and I'll sit at a quarter till now. If you take an overall fundamental backdrop like the deflationary backdrop we had, and you combine that with key technical support and resistance levels, that can be a very powerful spot to provide liquidity versus just providing a spot on a chart because it looks like whatever. And that, for me, is where the importance of the Rareview Macro newsletter comes into place. It's not, a huge sum of money from a monetary basis. I'm still down on the day, but I'm following the plan of working into these themes, playing those themes, and doing them in tactical spots. And we'll see if this keeps on going. But overall, I think we can, show a little bit of patience here. We'll get a little bit of a shallow pullback. We'll see, how they handle the S&P here. We've now made on the S&P a new multi-week low to start the quarter off. So we can get a sense already anyway that we play that accordingly. I'm doing some process and stuff here. Yeah, go ahead.
I got a question for you, and we also have a question for Denise. I'll get yours first. The question is, do you expect any tendencies in equities due to the first day of the month and first day of the quarter today, or does that come into play?
No, a lot of the aforementioned I just talked about is assessing, where the S&P is over the last 3 years, and on a quarter-over-quarter close. Again, Q3 was another positive month. So I think, what we are guaranteed in October is a 3 to 3.5% pullback in the S&P, given the underlying market internals that are out there, given the volatility we've seen. So S&P down to 1920 or 1930 seems like a real possibility to me, given what a deflation dynamic means to that. Now, does it happen in the first 10 or 15 minutes of the quarter? A lot of these trades can be based on trade flows. You don't always get the macro narrative that drives the trade on October 1st or on April 1st or on January 1st, if you will. There can just be some shuffling of positions. So, tread a little bit more lightly during this time. But right now, the theme that I highlighted at the beginning of this webinar was a deflationary theme out there, and that is punitive to all asset classes but the dollar and but fixed income and duration. And that bid is unrelenting in fixed income right now. And this is without any bad economic news. So I think there's some shorts here potentially in the fixed income that can get jammed if the ISM we get comes in a little bit light at the top of the hour, and that people begin to try and recalibrate to figure out, where they want to be positioned.
And Denise, this question's for you. Is there any way to train and develop this ability to think about the other players, and if so, what is the best way to start doing this?
Yeah, there are ways to train to do it. I will say we're actually in the process of developing some games to help people train, but they're not quite available yet. But you can do it by trying to consciously predict what other people are going to do when you're walking down the street, when you're driving a car, when you're standing in line at Home Depot. Like literally looking around and saying, what's my sense of what that guy's about to do? Like, because you're actually doing it. Your brain is doing it. So that the training is about becoming conscious of it and then connecting when you're conscious of your feeling about what someone else is going to do, what does that physically feel like? So the training is really about becoming conscious. And so the more times you can ask the question and the more times you can say, okay, what answer comes to your mind? What do I think, what do I think the big money's doing in the market right now? What's the first answer that pops in your mind, and how does that feel physically? Taking yourself through that sequence with focusing on your physical self will just help you become more conscious of it. And as you become more conscious of it, it'll be more natural to do. And we'll get you the games as soon as we get you the games. But it's not that hard. I mean, it sounds hard because you never took a class in school about it, but you're all doing it. You're already doing it. The brain has to do it. So it's just you're not taught to do it consciously or proactively in learning to trade. But yet it's really the only answer you care about is why someone's going to pay a worse price than you. And so the more you put your analysis within, how do I answer that question? Why is someone going to pay a worse price than me? The easier it will become to do consciously, and the easier it becomes to do consciously, the easier you'll be doing it, or the better you'll be doing it unconsciously.
Thanks, Denise.
Couple
John,
of things.
One more question
Go ahead, Doug. Please.
And then we'll just a quick one. Do you place your orders before economic numbers, or do you normally wait to see the reaction first?
Both. Gold making new highs. Interesting. That's not very deflationary. That's more position right there. There's a lot of shorts in gold right now. We're seeing a bid back up again. That's the one aspect of this, the deflationary thing I'm talking about that's not playing out. But I think that's more of a technical reason why. And this is where, if I can, this is the thing here. Let me get that spreadsheet back up again. This is where you look at gold on a risk-adjusted basis. Okay, let me share this in a different. Okay, two. Yeah. Okay. Annotate. Boom. All right. So right here, this part of the dashboard, you can see that silver's performing well. I mean, silver is if you look at silver on a daily, something Neil pointed out in the note this morning, was where the RSI on the daily chart is. So if we begin to get some position squaring here, you see gold. The Netto number on gold today is sitting around 40 right now. The Netto number on the fixed income today, you can see that how it's performing in that regard. So this deflationary thing is playing out because these markets on a risk-adjusted basis, TY, the 10 years, 5 years, 2 years, and 30 years, they have much higher Netto numbers or risk multiples. So it's like, well, gold is rallying. Yes, on a nominal basis, gold is rallying, but the Netto number on gold, there's my Bloomberg. Get off this screen. Glaring than it does about a longer term thing. I think longer term, you can actually use a bounce in crude here as a spot to come in and sell. Looking at crude over the last couple of days, had a lot of volatility, a lot of action. That movie from the movie Rounders, for those of you guys who know that, when Worm and Matt Damon are sitting at the table and like Matt Damon won't cheat and Worm's like a lot of action. So this is a place where the Netto Number Dashboard can provide a very good pictorial, and this is, when Jason Roney from Bluegrass Capital Management, shared some of these techniques with me,
this is the kind of stuff that you can do to at least, again, this ratio is done at a very basic level. You can get a lot more complex and robust, but these are the kind of things that Jason emphasized to me in terms of understanding the narratives. Gold today, with the market selling off, has a 38, risk multiple. It's up 0.38, whereas TY is up 1.1, 1.9, and so on and so forth. The dollar index on the day, which has been a huge theme, is like break even. So that's not consistent, or that's not congruent with the deflationary pressure, and that's why it tells me, at least in some of these commodities and some of these currencies, looking at this dashboard, that's the macro narrative behind this. And the real push is coming on fixed income, which didn't have a blowout quarter by any stretch, and so it's a natural place to gravitate for money to gravitate to, given the deflationary concerns, and that set up a nice pullback trade earlier, grabbed something on it, and we're coming to the ISM here, so I actually need to get a little more aggressive in my position, because I think if that bad boy comes in hot, or comes in a little bit light, we can see a continued up move on that. Boom, boom, boom. Okay, back to my bid, which has been stranded out there. Any questions over what I just went over?
No, but we got one more for Denise here. Denise, are there any distinguishing characteristics between market intuition and impulse buys and sells? You said earlier that maybe the impulses have more energy.
Oh, you mean, yeah. An intuitive feeling is a feeling that's generated from unconscious pattern recognition or experiential learning, and comes from staring at the screen for years and years and years. Those kinds of feelings are calm. They don't feel like, oh, I've got to do something. They feel like, oh, I know something. Oh, I understand something. They feel like, kind of like click. I get it. I comprehend what's happening. Impulse feels like I got to do something. Impulse got energy associated with it. Impulse or compulse are much more frantic, chaotic, need to act now. And so if you're starting to track emotions as data, and you're just trying to say, you can say, do I feel like I really need to do something? Does it feel high energy? If it feels high energy, I'd be suspect of it. There are times, and John's a perfect example, where intuition or unconscious pattern recognition does create energy, but it's more when John's like sitting, early in the morning, understanding all of his data points, and he feels like, okay, he's got this macro picture and he's got the technical levels within it, and he feels excited about areas that he could get involved in the market, in a few hours, later in the day as they play out. That kind of energy, looking forward to the day because you kind of understand where the market is not a bad energy. It's the energy in the moment, the high energy, frantic, chaotic, I got to do something. That's a place to say, I'm in my risk differentiation thinking, and I need to understand why I feel like I got to do this, because that feeling like I got to do it is probably a risk management signal, meaning I don't have to do it. Energy. Level of frantic, chaos. Now, John's a really high energy guy, but what you don't know that he hasn't talked about is John's done all kinds of work in self-knowledge, all kinds of work for all kinds of years.
For all kinds of years. For all the right reasons.
Yeah. So, implicit in what John's talking about and the intellectual abilities and experiential knowledge that John brings to the market is a great self-awareness that he can talk about if you force him to, but he's not necessarily going to talk about when he's looking at the German Bund and wondering why it's not doing what he thought it was going to do, say, vis-a-vis the deflationary.
And that's my own emotional. Well, we're 2.5 minutes for this release here. I'm going to start working to get in position. You can see my orders here. working from 5-years, working from 30s again. I think that part of the global fixed income yield curve is more susceptible if we get weaker data. Obviously, it's U.S. data, which would be weak, but you know, that would have at least in theory, should have a greater impact on that. Still down a little bit on the day. For those who remember last year, the year before, we were very fortunate in terms of the final P&L that day. Not quite the same ROI, but the process is actually only gotten better since then. So we're sitting here 2 minutes before this number comes out. I think if this number comes weak, there's a chance for this fixed income movement to keep going. I'm not going to be as aggressive as I was before on this because of the move we've had in fixed income. So some of the asymmetry maybe have been taken out, but this is, I think, is a deflationary thing going on. So I'm working a 30 lot of the 5-years right now, working another 30 below there, and I'm working 40 of the TY. So I'm gonna be long about 100 contracts. I think if this number comes in our favor, we can do that. I'm also paying attention to the employment component. So this number comes like 57, I can see it popping up here to like up to this area. So we're sitting. I have my trading team around me that they help call out these numbers and identify the subcomponents as they exist, and go from there. Here. Boom, boom, boom. Hit a clock, Wally. Yeah, call it out. Call it out. Yeah. Okay, so I'm long 40 treasuries now. Sitting at 30 seconds left. I get long one more. Again, I'm not gonna get married to this if it doesn't come our way. 40 seconds, okay. 20 seconds. That's a big miss we talked about. Big miss. Trying to let this work here. Trying to get a. Again, this is about the asymmetry in this market right now and how people are positioned. Fucking popping, baby. Taking new highs. Feel some there. Cancel those stops. Cancel those stops. Still on 22Y. Going to peel out and bid back in again. Yeah, this is what we talked about, guys. This is why having Neil's macro narrative behind me from Saturday on site sets me up and gives me the confidence to understand the position of the market here. We're not, we came in down 23, 20, 2,500, understood the positioning, tactically worked into the trade,
Gave you the confidence is the key point.
And took a bet that if this number missed, and it came in a big miss, 56.6 versus 58.5. And now we're seeing TY here, back a bit highs again. We got that big flush, and that's the symmetry of like, okay, how the fuck is this market? Sorry, how is this market positioned? And now I'm keeping an eye on the. If I can show you, this is my Bloomberg thing here. This is a chart between the 10-year bond and the Treasury, and you see here that the 10-year Treasury is now actually the yield is compressing between the 10-year Treasury and the bond, and that's saying that there's a dynamic in play right now with the interest rate differential that you need to be aware of, and so that is important.
A thing that everyone can do is always be saying, where am I on a spectrum of panic to overconfidence? Because you're always somewhere between panic, fear, anxiety, doubt, some amount of confidence, a little bit of confidence, a lot of confidence, too much confidence. that's the emotion that's in every decision at a minimum. And so knowing where you are and why will help you make better risk decisions. You know, all you really have to do is draw yourself a spectrum and put hashtags on it.
$125.09 is a balance point. Bill Glenn just called that out to me. We got commodities, crude getting up near highs, crude, or gold back near highs as well. Again, I think this is more positioning. If we kick back up and look at the spreadsheet here, but this market was bid all morning long. They would not. I mean, they let me get in once, and you know, just like a good woman, they don't give you a second chance, whatever that means.
You would have
don't give me a second chance.
You would have
like,
experience there too, huh, John? So I'm going to answer a question in the chat. It's definitely true that your personal life, emotions from your personal life will play out in trading. So if you've had a fight with your teenager or your wife or your husband, just keep your order.
Euro back at highs right now. So this is, we talked about the dollar strength going on here and the perception of the differential between U.S. growth and European growth. Take a look at the euro right now, it's back at highs. Gold's back at highs. There's some position squaring here. Keep in mind, I'm trying to go into hedging. I just want to make that point real quick in terms of what I'm watching in real time here as we continue on that path. Denise, go ahead. I'm sorry.
Oh, no. I was just, it seemed like there was a lull. There's a question. So it's not okay to trade angry. Well, it's just not a good idea. So you've always got an emotional context, a feeling context, like that's sort of what it means to be alive. And the feeling context includes your physical feelings and your emotional feelings, two different types as well as we can subcategorize that.
Neil was S&P bull in 1950. Go ahead, Denise.
But, I mean, I can tell you story after story after story.
I'm out. Taking profits. Taking profits. Just a feeling here that this is a spot that, you know, I want to get out, playing it. Go ahead, Denise, to take over. I'm flat right now and going to work some bids back here at the 08 half level. And also looking to get short some crude here on this bounce, on this position. I think this sets up well in the next hour to 2 hours on this crude bounce here, given the Netto Number Dashboard and where that's going. Hello?
Hi. So the point I was making, gang, is that, you know, you carry your feeling context from situation to situation. And, you know, what happens with anger specifically is, you know, whenever you're angry at someone, you're angry at a teenager, angry at your spouse, you have a feeling of being out of control, like why can't they see my point of view? Why won't they listen to me? You know, what's wrong with them? And then you come to your trading screen and you come to your order entry screen and it will do what you tell it. And so there's a tendency to work out that feeling of being out of control by getting into a trade because the screen will listen to you.
Real quick, I took an initial short in crude. This is my initial 2-lot. I may add 2 more of it if it breaks this high here, but this is my initial position. I like to work up to maybe 5 or 6 here, but that's my first initial spot. Is just thinking that crude, I can see crude back 30 to 35 cents from here back to 91.80. Continue on. I just want to update those people that I'm trading.
No, that's right. So you get this fleeting fleeting relief from the frustration that your teenager won't listen to you by putting an order in. It feels better for a second, and then you kind of know what happens from there. I once had a trader I was coaching who was coming up on his best month ever, and on Saturday found out that the people in his rental house had left the house and taken all the furniture. And, you know, needless to say, he got his lawyer involved, and he had not a great weekend, and he came in on Monday and basically lost his month, and he couldn't understand how A related to B. He was, you know, so exasperated and so frustrated over what had happened that he just traded crazy. You really can't underestimate the power of whatever feeling context you're bringing to the situation. But it can be turned into data, and you can use it. It's why control your emotions is such lousy advice, because you don't want to control them, you want to understand them. The only thing you have to control are your actions. And the easiest way to control your actions is by having your feelings and emotions, by identifying them, by putting them into words, by putting them in categories. Then not acting on them becomes easy, and you know what you start to learn what the intuitive feelings that you do want to act on are once you start treating the whole data set as data.
I'm going to flash back to the Netto Number Dashboard, and yeah, let's see here. Show my desktop. Where is the camera 2? Yeah, number 2. Okay. So let's just take another snapshot again. We can look at these. Look, I'm going to do annotation here. Annotation. We see. Move yourself over there. There you go. Equity indexes around the world. All right. And I could chart not only them, but their range. And then Netto number minus 1.17. The Kospi out there overnight did bad. We highlighted that earlier, so that's not so much effect now. But look at the Dow, S&P, and interestingly enough, you know, small caps today, a Netto number minus 0.64, and then you have S&P today, which is minus 0.89. So for you relative value traders out there, this is a great tool to just, again, from a conceptual framework, there are more robust models, but this is just, again, we're grabbing the envelope of what's out there. And again, you know, Jason, when you take what Jason Roney's done, when you take what Neil Azus has done from Rearview Macro, and you combine them together, you can see that, you know, a lot of us have struggled with technical systems just on their own. But when you blend the macro narrative in, and you blend your own emotional algorithm in, it provides the opportunity to make money. And I can speak candidly that, you know, last year I had a freaking absolutely blistering year P&L-wise. I mean, you guys saw it, I think came on here and made over $90,000, you know, in the day, or 100 grand, whatever it was. It was a pretty nice day. It's been a very tough year. Like, that's more money than I've made all year this year. From a macro standpoint, I've never been in a more challenging market. I've recognized that, and I'd say what the biggest thing I've done is, you know, I'm still up money on the year, you know, whatever, 7.5%, but I've kept my discipline, and I've understood my emotional algorithm, the competitive zeal inside of me that wants to chase, and but gosh, I made this much last year, and this much in 2012, and this much in 2011, this much in 2010, this much in 2009, you know, so it's like, I should do that again, but that's not how it works. And just conversely, if you're making money, well, I should be able to make this kind of money. That's not possible. No, bullshit. It is possible. There's no rules about what you can make and what you can lose in trading. And being aware of that emotional state is a big factor in all that. So, you know, for me, you know, Denise talks about the work I've done, and this has been a very challenging year for me. I wish every day was like today is going today, because frankly, we're now actually beginning to get macro narratives that are impacting price action. That's not been the case for a lot of this year. It's been, we've had non-farm payroll days in May and in July that totally freaking blew out the numbers, and there was just nothing, you know, we ended up with treasuries rallying to highs back on the day again. So the central bank influence and the randomness it's created in this market has given me a lot of challenges, but I've still managed to make money and still managed to refine my process and work with my team even closer, you know. It's pretty amazing stuff. So we'll just see how that goes. Our crude's pulling back here. Gonna pinch out of one of these crudes here. Got sold on one of those. So grab 20 ticks on one of those, and I got another one lot bid down at 87 on that crude. Trade again. I've been talking this morning about how I thought that was an issue. If you look here over this part of the Netto Number Dashboard, crude on the day up 0.41. This to me said it was more about positioning. If it's about positioning, you can sell at a technical level, and CQG makes all this possible. Any questions about that? I mean, this is a good day. I mean, $4,000 is a good day for me. and on a risk-adjusted basis, I took 2 positions. I lost in the ADP because I thought we can get a weaker number there and how the market was positioned. I lost 20% there and then made back probably $6K or so on ISM. So that's the kind of risk-reward profile you want to have with a trade you take on, and a lot of that comes from understanding the macro narrative. All right, we're covering our crude there, so we got that crude trade. We covered that, so made $480 there on that 2-lot, and that was ended up being a pretty nice spot to get short there before that pullback happened.
It's been a tough year for just about everyone. I mean, I have a whole desk in Asia just trying to sit tight until something really starts to happen.
Yeah, and I think, ironically, that this is the Q4 is that happened. Like I said, I think that you look at an S&P that's going to be down, 2 to 4 to 5% at some point in time overall in October. And when you get that volatility, when you have something like the ECB meeting tomorrow, when you get the VIX, coming off of trading at a realized vol of like 9, and the last couple of weeks we've seen a much different volatility path. There's a lot to be excited about in that regard. I'm going to go ahead and I'm going to stop sharing for a second, and I'm going to finish because I have some more aspects to talk about in my presentation here about the global macro edge. And I want to make sure I get. Can you guys see Denise? Do you see my presentation again?
Yep, I do.
Okay, cool. All right. So in the global macro edge, there's 6 points I want to hit on because this is a big idea. Because I know there's a lot of prop traders and hedge funds on here. More risk doesn't always equal more return. Jason Roney writes that chapter, and basically not every risk unit is created equal, and he goes over, why that's the case. Money doesn't always find its most efficient home. So in other words, there's opportunities out there. I talk about why cash, why not necessarily the best managers or the best products have the money, and why that creates actual opportunity in the market. And then, I talk about you can't have too much of a good thing. Basically why I blend the protein strategy, lots of strategies. Diversification isn't enough. Bob Savage goes into, what people think of as just class diversification. Well, you have a lot of, risk parity portfolios. For those who are not familiar with that, in essence, think about, okay, if I'm long this amount of bonds, this amount of equities, this amount of fixed income, or this amount of, illiquid assets, given a certain, macro profile, it should perform this way. Well, obviously long treasuries, long equities have just delivered superior risk-adjusted returns. So what happens when you think you have a diversified portfolio? Because of what the central bank has done, it's no longer diversified, because of all of a sudden interest rates, crush both your equities and your bond holdings. So that's something to keep in mind there. Why diversification? And then today's markets offer more opportunity, not less. I go into reasons why I think that despite the lack of volatility, despite my struggles, because of risk-centric technology, because of the ability to find manager talent, because I can subscribe to a Rare View Macro newsletter, okay, at a fraction of what it would cost me 20 years ago or 10 years ago to get the same kind of institutional information, because I can find a manager like Jason Roney to invest with, I'm in good shape. And then lastly, this is what I think is the ball buster of them all. Compensation should be based on risk, not return. And what I mean by that is this. Everything about the global macro edge is about maximizing return per unit of risk. So you tell me, everyone, if I freaking produce, you give me $10 million and I make you $3 million on that, or a nominal return of 30%, okay? But I draw you down $5 million to make that happen, versus I make you $3 million and I only draw you down $500,000. So I made $3 million, but I was down $5 million at one point, versus I made $2 million, but I was only down $500K at one point. The risk profile behind me making you $3 million while only drawing you down $500K is much different, and I should be compensated accordingly for that, or you should pay the manager that maximizes return per unit of risk or minimizes drawdown the most money. And it's my suggestion in the global macro edge that compensation in the entire fucking alternative hedge fund space should not be this bullshit 2 and 20 that, if I make you $1 million, who cares about volatility? I'm freaking collecting my incentive fee. That's bullshit. You should get paid based on how much alpha you deliver, not the beta you deliver. And that comes by paying you, or at least the start of that comes by paying you on the money you make relative to your max drawdown. So if you generate me $1 million, going driven down $500K, that's a phenomenal risk-adjusted return. That's 2 for 1. That's a great risk-adjusted return. I should pay you more than a 2 and 20 for that. But if you make me $500,000 while drawing me down $700,000, I'm not sure you have any edge whatsoever. So I think that's the conclusion, and that's why this book, between the strategy talked about, between how to diversify between, incorporating a qualitative macro perspective like I just showed you in the last, hour or so. I'm really excited about this, and every dime of profit from this book, every effing dime of profit from this book is going to go to help returning veterans from Iraq and Afghanistan get service dogs. I have a dog. I love my pets, and it's good stuff.
Thanks, John.
I guess I
got a few questions.
Yeah, go ahead, fire away.
We got a few questions on the Netto numbers. Can you, since actually our WebEx is numbers, can you talk about how they're created and how they help you?
Sure. Again, let me slide this, or let me go. The Netto numbers are something that you can go back, and if you want to, from a very simple perspective, like, okay, the Sharpe ratio of this product. All right, when you think about like why Sharpe ratios were created or why things that measure risk-adjusted returns were created, it was to get a better context of how the market's performing. All right, when you turn on CNBC in the morning, okay, and you see that, like I'm looking at CNBC right now, Dow is down 14, S&P's down 14 points, down whatever 70 basis points. Nasdaq's down 43 points, down 97 basis points. As I'm looking at right now, cruise up 77 cents, up 83 basis points. That's only a starting point to give you the market message. I don't really know what that means though, okay? Like, what does it mean that crude's up 70 cents? And so what the Netto number does, and when I asked Jason Roney to help come up with something that people could use to easily understand this, it was, how can we make it so that we can compare performance of products on an apples-to-apples basis with each other? So if I can say, all right, the crude being up 70 cents means a lot more to me than the S&P being down 10 points, because crude, whatever, only trades in a dollar range per day. So, with crude trading in a dollar range per day, and it's up 70 cents, that's 70% of what its range is. Let's say the S&P has, and this is not a very good example, but the S&P has, let's say the Dow. Let's take the Dow and the S&P. Here's a good example. The Dow has an average range every day of 200 points. The S&P has an average day every day of 20 points. All right. The Dow is up 200 points one day. The S&P is only up 10. So the Dow is up one full risk multiple of its average performance, where the S&P is only up half a risk multiple. If all of a sudden I can compare markets based on risk multiples, not based on nominal performance, I can compare markets from a much wider perspective. And, as Jason taught me, the markets that, are up 1, 2, and 3 risk multiples are telling you a much different macro message than the markets that are only up half a risk multiple or up a quarter risk multiple. And listen, there's lots that goes into interpreting these things. This was just to get you started to conceptually think about, okay, how can I do this? Let me go back to the share function here again. My desktop, blah, 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 blah. There we go. Okay. Boom. Got a blackout here momentarily. Okay. Boom. Alex, I need you on the clock here because I have an crude inventory number coming out. I need it 7:25 spare me, okay? Say crude inventory in 5 minutes, because I think there's another setup here with this. There may be another setup with this crude number. And so if you look here, like, all right, just the ability that I have to say, okay, I can quickly look at the currencies. All right, New Zealand dollar of half a risk multiple, Canadian dollar 3/10 of the risk multiple. British pound of a quarter risk multiple, dollar index basically unch on the day. Okay, that's fine, but let me go to a longer term frame. Well, actually, we see the dollar index here is up 1.43 from a longer term Netto number perspective. And I can see also where it sits in that range. Tom Hartle designed an ability to look at where that Netto number was in its range. So all of this, again, I can't thank Jason Roney enough for this, but it allows you to add another interpretive qualitative factor to what's going on. So what are some of the problems with this? Well, you need to understand what macro regime we're in, okay? This gives you a framework for what markets you can track, but if you don't understand the qualitative or macro drivers behind why these markets may be higher, like you may see New Zealand dollar today up, oh, look, it's the top of the leaderboard, I should go long. No, mofo, you shouldn't go long, because look at this thing on a longer term basis, or maybe there's a news item that came out that drove this higher. So this at least alerts you to where maybe you should be focusing on, but it's by no means a standalone system. It just allows you, because everything I do and everything the Global Macro Edge does is, how can I maximize return per unit of risk? And you maximize return per unit of risk by understanding how to assess every trade, every strategy, every position, every portfolio for a risk-adjusted basis. And so I can assess all these markets from a risk-adjusted basis, how they're performing on a risk-adjusted basis, and which are underperforming and which are overperforming, that provides a great framework for me to move forward. And that, everyone, is the freaking global macro edge. Questions?
All right, here's a question, John.
Yeah.
Does it mean that the market is up a full Netto number? It has twice the probability of giving that back when the market that is up half a Netto number and therefore closer to its center of gravity?
Out freaking standing question. The question is, does the Netto number mean because it's up one that it can then give it all back? Does it mean that it's down, it's only up half one, half chance to give it back? I don't use them in that way most of the time. Again, I use them from a standpoint of which is performing best and worst, and how can I contextualize that performance? It's not, I have not done the studies to say, okay, over 10,000 samples, say for every time a Netto number gets to this point, how does it come back, or what percentage of the time it come back? It's more about, I need to know right now which markets on a risk-adjusted basis are performing good and performing bad, and which are the worst and which are the best, and how does that fit in with my macro narrative? How does that fit in with what Neil Azus talked about inside the onside? How does that fit in with what Jason Roney's telling me? How does that fit in with where I see market positioning, okay? So if, let's say, you know, and that, it's from that perspective I use these things. And so if we look here, you know, it's some of the synthetics out there. Like I'm charting, you know, gold and Aussie dollars, okay? So gold today in Aussie dollars is a Netto number 79. That's a synthetic cross right there. It's not something that most people pay attention to, but you have a commodity and commodity currency, so it tells me, that's a message there if maybe there's a relative value trade I can put on, okay? But I look over here on the longer term chart and it's only 0.17, so honestly, it's not that, maybe it's not that telling. Overall though, I mean, that's what, I say, I was like, I'm gonna short some more crude again. Yeah. I'm gonna take my screen share back to the positions. I wanna get short some more crude here. We do have an inventory number coming up, so I got to be careful on that. But overall, though, I say let's press it. You know, we got a market that's moving on the day. I think crude, you know, is trying to bounce off this support here. But overall, though, I want to get short again because I think there's a real good shot that was the high of there at 92.20. So I want to start positioning again into this. We have an inventory number, but I can just see my feel of this, and this is a feel thing. This inventory number, you know, the market's selling off after this comes out.
Some crude-related questions, John. Do you enter stops as you put the trade on, and how much are you going to risk on this crude trade?
Maybe $1,500, $1,600, $1,700. So if I'm in a 10 lot or 20 lot, I'll see where it's at. I may go even 2,000. If we get a big pop in the next 5 minutes, I'm actually excited to go risk more, you know. If we don't, then I'll probably be in between 12 and 15 contracts. I'm going to see how I feel. I mean, I have the general basis down, Denise. Denise could talk about this. But in terms of the final bit, I just rely on sort of how I'm feeling and how I'm seeing the market play out there.
And that's a phrase that I just want everybody to remember. When you listen to great traders, they use that all the time. It depends on how I feel. It's astounding to me that.
What do you think of target on that, Giselle? What do you like that target? I'm talking to my brother now who literally is running 7 systems in the background. He's always calling out trades to me. Trend following, mean reverting volatility. Okay. All right. Gotcha. Okay.
And you know, we're supposed to end at 8:30, John. We'll hold this a couple minutes past.
Yeah, let's see how this
the 8:30 number, and then we'll close out.
Yeah. So one way or another,
we'll
be up 2,500 or up 6,500 or 7,000-ish. That's my profile on the day. And if you keep putting yourself in those spots, you know, we came in, we were down, we stuck to the plan. You know, maybe we'll end up around even. Maybe there won't be any announcement at all. Wally, I'm going to need you on the call out on the crude number at 7:30, please. Again, I have a team around me that's helping me call this stuff out. And again, this is real trading, people. Obviously I come in, I show I'm down on the day, come into the day. I'm not afraid to show my P&L. I'm not afraid to say, hey, this is what I'm doing. I'm getting freaking crushed. You know, I'm losing, I'm winning, whatever. This is really about the process and working with Denise to outline some of this stuff. So we'll see. You know, maybe if I'm right about this and crude does put in a top here, maybe we can grab some more. If not, you know, we'll get out and get ready for the next day.
I did want to make a comment for everyone. A specific feeling that you should be looking for is the fear of future regret, or fear I'm going to feel bad in the future if I don't take this trade, if I get out of this trade at the worst point, if I miss this trade. You can call it fear of missing out, but fear of missing out is a specific kind of fear of future regret. And so if you start looking for that emotion as a data point and then realize that's not a feeling you want to be acting out on, basically your self-knowledge and therefore your risk management, risk differentiation will improve.
All right. Now we got 2 minutes to go.
All right, I'm short 5 crude right now. Those TYs aren't going to get filled here in the next little bit. Vehicle sales are coming out here. I'm getting those announcements.
All right, quick question. What technical analysis are you using? Profile, fibs, pivots, V-bands?
Profiles, fibs, freaking, chart pattern recognition, all the above. And again, I contextualize all of that. But here's the saying I have. It all works and all doesn't, okay? Counterfeits work and they don't work. They can fail horribly. They can work great. Fibs work horribly. They can work great. It's the context of what regime we're in. Are we in a mean reverting regime? Are we in a trend following regime? We're sitting at minute left here. Are we in, what kind of regime are we in dictates the level of emphasis I apply to that respective strategy and to that respective asset class. Okay. Call it out, Waller. Just scream it out, buddy. It's all good. Gold pulling back now. Again, we talked earlier about. All right. Short 10 crude now. Whew. Short 5 more. I feel it. I'm going with 15. I'm going with 15.
5, 4, 3, 2. Inventory sell 1.36 million barrels.
Okay, boom, I got stopped out. All right. Wow. Okay. Fair enough.
Hey, Amit, can you put up the slide with John's and Denise's email? Because we weren't able to get to all the questions in this last hour and a half, but certainly let's post that for everybody that's on the call.
So I got stopped out 9210 and given back about 3,000 actually. That was a pretty big beat there, and there you go. So I ended up making a little over 2,000 on the day. Tactically worked positions. Actually was positioned, lost 2 out of 3 trades and still made money. So that just tells you, from a contextual standpoint, how important that is and why it's important to manage risk. So overall, good stuff. I'm very pleased. Let me, so again, just fair disclosure, I'm 2139 on 209 by 209, traded 100 TY, traded 90 FV, traded 19 by 19 crude. And pulled down a little over 2,000 on the day. After commission, a little bit below that, but that's 2,000 bucks. And that's the process, everyone. That's full disclosure, full transparency.
It doesn't feel good to lose, does it, John?
The competitive side of me doesn't like it. You could probably, I fucking hate it. I don't like losing.
Thank you.
I don't like losing. But the harder thing to do, and this is where this is what took my P&L from making 6 figures a year to making 7 figures in a year, is when you're up, the inclination to protect your profits and to not operate system is so powerful that I fight through that. And you can never make 20,000 a day if you stop at 10. You can never make 40 when you stop at 30. You can never make 100 when you stop at 50. Okay, so it's where was the process there? How was the risk managed? This is a freaking great trading exercise today. Great stuff.
Well, I want to thank you guys for coming on for the last hour and a half. Again, it moved much faster than a normal hour and a half of my day. And certainly we got a lot of good information. This year we got to see the Netto numbers, and posted on the screen is contact information for both John and Denise. Please contact them with any additional questions or any ones that we might have missed. This webinar is recorded and will be up on our website within the next day or two. And this is Doug at CQG signing off. John, again, thank you, and Denise, and hopefully we'll do this again within the next year.
Thank you, Doug. Thank you, Denise. Great stuff, guys. Wonderful stuff. Thank you.
Bye.
Thanks a lot. Take care.